The 2008 financial crisis was supposed to be the wake-up call that changed everything. Congress passed sweeping reform legislation. Regulators imposed new capital requirements. Politicians told the public, "We fixed it. Too big to fail is over." That was a lie. Because the solution to too big to fail was, in many cases, to make the failing banks even bigger. The four largest banks in the United States collectively hold more assets than at any point in American financial history. The story of too big to fail doesn't start in 2008. It starts in 1933. Congress passed the Glass-Steagall Act. It drew a hard line between commercial banking and investment banking. Keep the casino separate from the savings account. Then came 1999. The Gramm-Leach-Bliley Act repealed Glass-Steagall. The wall between commercial and investment banking came down. Once you removed the legal barriers, size became the ultimate competitive advantage, and so the mergers began. In March of 2008, Bear Stearns was collapsing under the weight of its mortgage-backed securities exposure. The Federal Reserve facilitated an emergency sale to JPMorgan Chase. JPMorgan got an enormous book of assets at a fire sale price, backstopped by the Federal Reserve. Washington Mutual, the largest savings and loan in American history, with over $300 billion in assets, failed. Bank of America acquired Merrill Lynch. Wells Fargo swooped in and acquired Wachovia. The crisis created by banks that were too big was resolved by making those banks even bigger. Congress passed the Dodd-Frank Act in 2010. It did real things. It created the Consumer Financial Protection Bureau. It introduced stress testing. It imposed new capital buffers. But here's what Dodd-Frank didn't do. It didn't break up the big banks. It didn't reimpose Glass-Steagall. It didn't shrink JPMorgan, Bank of America, Wells Fargo, or Citigroup. Complying with Dodd-Frank costs enormous amounts of money. For a community bank with $500 million in assets, the compliance burden can be existential. In 1984, there were over 14,000 banks in the United States. That is a 68% reduction over 4 decades. The assets that those disappearing banks held didn't evaporate. They flowed upward into the biggest banks continuously. Then came 2018. The Economic Growth, Regulatory Relief, and Consumer Protection Act rolled back significant portions of Dodd-Frank under $250 billion. For banks with assets, mid-tier banks, freed from some requirements, were now incentivized to grow aggressively to take on more thresholds, to expand their balance sheets, which is exactly what contributed to the collapses of Silicon Valley Bank and Signature Bank in March of 2023. What happened in the immediate aftermath? The deposits fled from smaller and regional institutions and piled into the 4 biggest banks. The implicit guarantee was obvious to everyone. These 4 banks will never be allowed to fail. 2. The too big to fail designation isn't just a description of size. It is a subsidy, a permanent, unlegislated, effectively unconditional financial subsidy. When depositors believe your bank is too big to fail, they trust you with their money in ways they might not trust a smaller institution. The too big to fail designation is a subsidy that flows to the largest banks and away from their competitors every single day. Today, JPMorgan Chase alone holds over $3.9 trillion in assets. JPMorgan Chase holds assets equivalent to roughly 57% of the entire annual federal budget. Together, the top 4 banks hold somewhere in the range of $10 to $11 trillion in combined assets, representing roughly 40% of all banking assets. When 4 institutions control 40% of the banking assets, they also control a disproportionate share of the credit that flows through that economy. The loans that small businesses need, the mortgages that families need. The concentration keeps growing, not because of dramatic crises or emergency mergers, but quietly, mechanically, through the normal functioning of the industry. Every crisis, without exception, ends with the biggest banks holding more assets than they did before the crisis started. Maybe the 4 biggest banks are individually more resilient than they were in 2008. But resilience of individual institutions is not the same thing as resilience of the system. A system where 40% of all banking assets sit inside 4 institutions that the government has demonstrated it will never allow to fail is not a fixed system. It is the same system, just bigger. If you are too big to fail in 2008 and you are allowed to get significantly bigger in the years that follow, what exactly are you now? Hit subscribe.